Welcome to the 6 pillars of building generational wealth through investing in real estate. We are so excited to have you all here today to share with you the techniques that our family has used for generations to grow wealth. I'm Lisa Wan, and I'll be your moderator for today's session. Before we get started, I want to point out a couple of little admin things. On the right-hand side, I want to highlight 2 sections. The first one is the chat room. Please go in and use the chat room, get to know each other, have fun with it, chat amongst yourselves. Get to know our great team that we have on the ground in Washington, California, and Texas. I know you'll really enjoy getting to know them and working with them. So the second thing that I wanted to point out was we're going to have several polls today, and those are going to show up on the right as well. Tell us what you think when they pop up, and Paul will cue you so you'll know that they're there, but we really do want to know what your opinions are. So now, without further ado, I would like to introduce Paul Wan. Paul Wan is our keynote speaker for today's session. Paul is 4th generation to work in real estate with over 25 years of experience himself. Paul applies his experience in finance and institutional asset management to put together creative and profitable deals and investment portfolios. He does this for everyone from the first-time investor to seasoned professionals. By the end, it will be clear why Paul has earned 3 Lifetime Achievement Awards and is a member of the coveted RE/MAX Circle of Legends. Now please join me in welcoming Paul Wan.
Lisa, today I'm really excited to talk about what we're going to learn in this presentation. We're going to show you how to create your own customized 5-year wealth building plan. We're going to show you how to get access to coaching and mentorship to make that vision a reality. So we're going to start off in this presentation. We're going to have quizzes and polls and different things like that. So the first thing I want to ask you is, how much money do you think you need to retire comfortably? Our moderators will go ahead and answer that, but go ahead and talk about it. Answer the poll, talk about it in the chat, and they'll discuss that in the chat afterwards. Well, let's go ahead and get comfortable with that, and let's move on with the presentation. I'd like your permission to speak frankly. Most people in the United States are unaware of a huge financial crisis that's currently impacting our society. So I'd like to ask you to keep an open mind and think logically and mathematically, because there can be a lot of emotion tied up in this because it's a really big issue. So with your permission, I'm going to go ahead and explain this, and we'll move on and discuss that in more detail. The issue that we're facing is that bankruptcy in retirement is escalating to the point that 2 out of 3 Americans are running out of money during their retirement years. The fastest growing demographic are people that are over 100 years old, and a couple today that's alive has a 25% chance of at least one spouse living to be 97 years old. People are simply running out of money because they don't have enough money to retire in the first place. So let's use an example. We've taken an example of somebody who's doing everything quote unquote right according to our economy. Our society says that if you pay off your house, put money in your qualified plans, and you work hard, then everything's going to be fine. So we've gone ahead and used this example, and we put it through the industry-leading software showing somebody who's doing everything right, and we'll see what their experience is going to be. So we have a married couple that file their taxes jointly, which gives us a tax bracket. They're currently 45 years old. They have a gross annual income of $120,000 a year. Their goal is to retire at 65. Very common so far. They own a home that's worth $750,000 right now, with the goal of paying it off. So you can see their mortgage is paid down already to $300,000. And the total budget that they live on right now is $95,000 a year. And they want to duplicate that budget when they retire, of that spending power of $95,000 a year. So if you look at this next slide, you'll see that there's a graph or a box on the left-hand side. And it shows that right now, they've got a couple 401ks. They've got some money in stocks and bonds. They've got some money in checking. But by far, their biggest asset is their home equity. And that's the truth for the majority of Americans. So you can see they've got 20 years to go for retirement. They've already saved $633,000, and they're saving almost $20,000 a year. This, unfortunately, is an example of people that are doing better than the vast majority of people in our society today. But the question is, will they run out of money? If they retire at age 65 in this current situation, continue doing what they're doing, we put this through the industry-leading financial planning software, and let's take a look at what happens. By age 80, they're out of money. They are statistically probable to live longer than 80. What do you do when you're elderly and bankrupt? There's nothing good that happens there. Now, we wouldn't bring up an issue like this if we didn't have a solution. So let's go ahead and talk about that solution. But let's go one more poll real quick and ask you, now do you think you have enough money to retire comfortably? Go ahead and answer the poll, and our moderators will discuss this with you, and let's just get back to the presentation. So who can we help here at the WAN Group? Entry-level investors many times think, I haven't even started investing. Maybe I haven't even purchased my own home yet. I don't really have the ability to get going. That's a situation that we find a lot. And a lot of times people tend to think, well, if they can help entry-level investors, then they really can't help established investors. Established investors are the ones that we find leave the most money on the table. In fact, I've yet to meet with anybody who's been investing in real estate for any length of time that haven't been able to show how to double their lifetime net worth. And what I find that happens consistently is when people start making money through investing, they feel like if they're making money, then they're doing it right. My thought is, if you're making $1 when you could be making $5, you're leaving $4 on the table. Entry-level investors, they haven't got any bad habits yet. They're ready to get started and put together a plan and keep working that plan effectively. So the thing is, we've taken people that are just graduated from college. They don't have any unique type of job. It's a normal type situation, no significant assets to start with, and taken them from buying their first home as an owner-occupant to owning a 7-figure home and 8 small apartment buildings within 10 years. Last year, their portfolio appreciated by over $3 million, having done nothing to it other than maintaining what they had, and they started with nothing. So whether you're an entry-level investor, an established investor, just anybody that doesn't want to be among the masses that run out of money during their lifetime, let us know, and we'll show you how to put together your personalized wealth building plan. So think about, if we want to make sure that we don't run out of money, we want to make sure that we have a safe retirement, something that's comfortable. We've got to think about specifically, what do we want to accomplish? If financial security is high on your list, then we have to ask, how much money do you actually need? What is the ideal asset mix to build and maintain that ideal portfolio look like? And then we have to gather and review all of that financial information to come up with that plan. Now, the key is, the backbone of our system is we develop this 5-year plan, and then we update it every single year to keep it current. So how much money is enough? Inflation, the rising cost of living, is an issue that we always have to be concerned with. This is something that's been around all of human history. But as you likely know, we work in multiple markets. And so we have our Southern California office, worked there for many years, obviously in addition to Seattle and Dallas and some other markets as well. But I remember being there, working in the LA office during the week, and stayed over the weekend and went out to brunch at Laguna Beach, just south of Main Beach. For those of you that are familiar with Laguna Beach, there's an old hotel there, and they've got a restaurant right over the sand in the back. So you have to walk through the hotel and down through the hallway. And as you're going through the hallway, I noticed a brochure from the 1960s era that shows that their best oceanfront room was $12 a night. And I can just imagine some young couple being on their honeymoon, or maybe an anniversary or something, thinking, honey, when we retire, we'll want to come back here. And I know things get more expensive with time, so we're going to have to figure it's probably going to cost $25 a night by the time we retire. The thing is an oceanfront room in Laguna costs over $1,000 a night. And most people look at the Consumer Price Index, or CPI, as the most common determination of inflation, or index that we use for inflation in finances. CPI tends to cut your buying power, or the Consumer Price Index tends to cut your buying power in half about every 20 years. What a lot of people don't understand, though, is that there are multiple indices that we can measure inflation by. The consumer price index was just one. For example, there's a luxury goods basket. The consumer price index doesn't typically cover things like housing and energy and things of that nature. But the reality of it is that luxury goods tend to cut your buying power in half about every 10 years, or about twice as fast as CPI. So the thing is, you need to determine what inflation rate you want to plan for, but we'll use CPI for the purposes of this presentation so we can just keep moving on. But just want to make sure that you're aware that there are different ones that we can look at. So what the most common roadblocks we see to people being successful in their financial planning, is not being on target with their retirement savings, not being where they should be. Another huge one is having an unclear financial vision. If we can't even think about what it is we're trying to do, it's very unlikely we're going to accomplish anything amazing. And unrealistic expectations. Thinking, I'll find something that's going to save me in the end. The bottom line is, most people don't realize they're at risk, therefore they don't do anything to fix it. And the most common retirement plan, wealth building plan that we see is putting your head in the sand and pretending everything's going to be okay when 2 out of 3 people are running out of money in their lifetime. So the average retiree's goal in the US is to save up a pile of money, and then once you've saved up that money, quit working and then hope that you die before you run out of money. There's a few issues with this. Number one, most people are very familiar with the fact that I don't have to pay tax if I put money into qualified plans like 401ks and IRAs. But they forget they have to pay tax when they take the money out. Most people will pay approximately 25% of their entire value of their retirement account in tax alone. So if we subtract the money for tax, you're going to find that they're already going to run out of money 15 years after they retire. Now, out-of-pocket medical expenses. People don't like to think about this, but 84% of the population of the United States will need $250,000 or more for end-of-life medical expenses. Now, all of a sudden, you look at this retirement account, and you're like, I don't have enough money to live to be 90 or even 80. Now I'm going to be out of money by the time I'm 75, which points to the issue. The issue is the vast majority of people simply don't have enough money to retire, but they retire anyway. At the One Group, what we teach people to do is that understand that they need more money before they retire. Show them a proven, safe way of getting that money and then maintaining that money in such a way that they live off part of the return of the assets. That way, they never spend the principal. The first rule in wealth management is never spend the principal. If you never spend the principal, you'll never go broke. In this method, every year you live, you become more wealthy, not less wealthy, more financially secure, not less financially secure. It's something that's very exciting, and we're excited to be able to share this with you. So how much money is enough? If we want to be safe, we want to be comfortable, then we need to know what we're shooting for. And if we want to be successful, we need a very specific goal. Let's say your desired spendable income in today's dollars is $100,000. And you want to retire in 20 years, and you're using consumer price index or CPI as your inflationary figure. That means that you will need to have about twice as much as you're looking in today's dollars in order to have that same spending power. But you also need to look at the idea, are you at risk in anything other than inflation? For example, would you like to consume any luxury goods? When most people retire, they're going to want to do things like go on vacations and travel and things of this nature. So we might want to build in a little bit of extra money for that type of a situation. But let's just use CPI as we talked about. So in getting that crystal clear plan, we need to understand how much money do we really need to make this a reality. So this is a very simple little formula you'll see on the screen right now that's outlined in red. It's just a little algebraic formula that says 200,000 in 2042 is equal to 5% of $4 million. So that's saying from 2022 to 2042 that you would have to have $4 million invested in order to make $200,000 a year at a 5% return. And the reason we use that 5% return is we find that for most people, we can maintain about an 8% return on their portfolio once they retire and still keep it safe and appropriate for a retired person. So in this example, if I want to retire 20 years into the future, I would need $4 million to retire, so that if I earn 8% off of that $4 million, then I can consume 5% of that, which is equal to $200,000, and always have more money the next year than I had the previous year. So that's an example of a way that we can get down to how much money do you really need. Now you see in this example, these people need $4 million. When they retired, they only had $500,000. Why do we use $500,000 as an example? Because that is more than most people have when they retire. And we wonder why people are going broke during retirement. So another poll, are you on pace to have enough money invested to retire comfortably when the time comes? Go ahead and answer the poll. Talk amongst yourselves in the chat. The moderators will work on that, and we'll get back to it. So why do traditional investment strategies fail? I've had the good fortune of being involved in the financial investment industry in one form or another my entire adult life. And the thing that I've seen is it doesn't matter whether we're talking about real estate or stocks or commodities or derivatives or gold or anything. People are always asking, what is that one thing that nobody else knows about? Do you have any hot picks, any hot, stocks, any hot properties that nobody else knows about? See, here's the thing. If you rely on something that nobody else knows about and cannot be duplicated for your financial security, you're destined to fail. You have to be able to build financial security with things that are readily available and can be duplicated so that you can have a successful model for your entire lifetime and not be subject to some hot thing that nobody else knows about that you cannot control. Because what we see, the statistics show us, is that most people lose about 3/4 or more of their potential return by looking for the latest IT investment. And when it doesn't work out, they sell it and buy the next one that's the latest IT investment. And they're just throwing money away by turning their portfolio when things don't meet their needs. And so we have to have something that we can duplicate. And we're going to show you how to do that today. So you probably recognize Warren Buffett. I love this quote. Never depend on a single income. Make an investment to create a second source. And yes, we're going to show you how to create multiple sources of income and develop that investor mentality. So let's talk about that investor mentality. One of the big keys to the investor mentality is understanding how to do more with what you currently have. If you're always waiting to start some point in the future when you're in a different situation, guess what? You'll never start. So we have to learn how do we do more with what we currently have, and that's where the power of leverage comes in. So if we take an example, the thing you're going to find, I find that having done this for many, many years, this is one of the most misunderstood things, and most people think they understand it. So let's go through, and hopefully this clarifies some things for you because it's very powerful. If we take a home that's owned free and clear, most people's goal is to pay their house off. Let's use an academic example of that property value of $1. If you own it free and clear, as you'll see on the left side, your property value is $1, you've invested $1. Okay? You've got no mortgage. The bank's invested nothing. You have no borrowed funds. And the market, the value of the real estate market goes up by 10%. That means that your house that was worth $1 has gone up by 10%, which equals 10 cents. 10% is 10% of $1. So far, so good, right? So let's check the next slide. Let's assume that you had a 50% mortgage. Now your property's still worth $1, but you've only invested 50 cents. The bank has loaned 50 cents. You've loaned 50 cents. Now, the real estate market goes up by that same 10%. But is that a 10% to the person that's invested 50 cents in this house? No, it's actually a 20% return on the 50 cents invested because the real estate market appreciates the same regardless of whether or not there's a mortgage on the property. So let's go ahead and take this a couple steps further. If we look at a 75% mortgage, which is a little bit more typical, the property is valued at $1. The amount invested is 25 cents. The bank has loaned 75 cents. I've invested 25 cents. The market still goes up by that same 10%. But that 10 cents is equal to 40% of the 25 cents I have invested. I've now made 40% in the same situation where I would have made 10% had I structured my investments the same way that everybody else is doing. But everybody else is running out of money 66% of the time during their lifestyle. So let's take it a little bit further. Let's look at a more realistic example. You've got a property that's worth $1 million. On the top left-hand side, you'll see the property is worth $1 million. I've invested $1 million. Now, the bank has loaned nothing, and I've got $1 million invested. For example, the market goes up by 30%, the value of the property goes up by 30%, then I have made a 30% return. Now, if you look on the right-hand side, I've got a leveraged property where somebody puts 25% down and they've borrowed 75% from the bank. The market goes up the same 30%. Instead of making a 30% return for a house that's paid for free and clear, or a property that's paid for free and clear, they now make a 120% return. This is one of the critical elements that gives investors the ability to make up for lost time and to get a portfolio large enough to protect them into their old age. So this is a different way of looking at it. We try to use a few different ways. Look at some graphs. We'll use pictures, we'll use words and numbers, but let's just look at this real quickly in one place. If I've got a property that's owned free and clear, my return on equity when the market goes up, let's take Dallas. It's one of the markets we work in. Since 2013, the Dallas market's gone up 150%. That's slower than some of the markets that we work in and faster than others. But it's not that far off of the average of major metropolitan areas. So if I owned a property free and clear, I would have had a 150% return. If I had a 50% mortgage, I would have had a 300% return. And if I had a 75% mortgage, I would have had a 450% return. Using leverage is one of the key elements of building a portfolio that can provide for your family financially for your lifetime and into the future. So let's talk about some other aspects of the investor mentality. Diversification. Many people really misunderstand diversification. Diversification is all about risk reduction. I hear people tell me all the time, Paul, I'm diversified. I have income stock and blue chip stock and international stock. And I kind of smile and I say, well, it's not all stock. If I told you I was diversified because I owned single family rental homes, duplexes, and fourplexes, does that sound diversified? You say, no, that's all real estate. You need to understand, without diversification, an investor becomes a gambler. Because if things don't always go your way, then something's going to go wrong. And I've lived long enough, and I think most of us have lived long enough to realize that there's never a time when everything always goes your way. So let's take a look at what real diversification looks like. At the One Group, we believe in 6 pillars of wealth, which we think of as true diversification. We'll go through each of these today. Our goal is going to spend most of our time talking about real estate because that's the purpose of the presentation. But we're going to briefly touch on all 6 of these pillars because they're crucial to having a successful real estate investment portfolio. So the first pillar is liquidity. Reserves must be maintained in order to ensure your ownership of the property for decades or more. You'll hear us say many times, it's not about timing the market, it's about time in the market. If you think about this, if you know somebody who's owned an apartment building since 1985, you'll probably find if they have maintained that building, that they've made quite a lot of money on it. Now, if they told you, I made this great deal in 1985 and I made this huge profit by selling it in 1987, you say, big deal. You made a few $1,000s when you could have made millions. It's not about timing the market, it's about time in the market. And liquidity is what ensures being able to hold time in the market. Those are the liquid reserves for the things we didn't expect. Without liquid reserves, an investor becomes a gambler. I've seen these TV shows, I'm sure everybody's the same, where they've got people that are flipping houses and that kind of a thing. And one I saw just drove me crazy. They said if they didn't sell the house in 30 days, then they would be out of money. And I'm like, that is not investing, that's gambling. Liquid reserves are required to be able to deal with situations happening we don't expect, because that's one of the few things in life we can guarantee. There will be things that happen that we don't expect. The next pillar is real estate. And we're going to spend most of our time talking about real estate today. But real estate is the single most effective investment tool for creating new wealth. In fact, the vast majority of new millionaires in the United States made their money through investing in real estate. It's often the only asset class that has the strength to make up for lost time without risking financial failure. We talked about leverage and how we could turn a 30% return into a 400% return by using leverage. The inherent stability of real estate makes it a sound investment choice for nearly everybody, and the ability to safely leverage it makes it extremely powerful. When we're talking about real estate, I do want to point out, we're talking about quality real estate. They're talking about the 50 top major metropolitan areas in the US with high quality locations and properties, diversified economies, positive population growth, which gives us the highest probability of success. Real estate has a low risk of volatility. Short-term changes in value are unlikely to change expenses. So for example, we've got a property, we're going to be using it to create income, renting it out to somebody. So, blips in the value of real estate don't impact the lease rate, typically don't impact the expenses, the utilities and things of this nature. The income and expense ratios remain very stable. The issue is we need to be able to maintain that cash flow, and by using reserves and the fact that there's a low risk of volatility in income producing real estate, we find that we can create portfolios that are very, very safe for long periods of time. Real estate's also tangible. What does that mean? You can live in it and other people can't live in it. You cannot live in a stock. There are most of the things that we invest in we can't tangibly use. The fact that real estate is tangible, we can live in it, other people can live in it, gives it an inherent value that other assets don't have that are not tangible. We can also insure it against loss. It's very difficult, it's possible, but it's much more expensive to insure other asset classes against loss. But we can also insure it against liability. For example, what happens if somebody is on our property and gets hurt? How do we insure that? It's all built into the real estate insurance system so that we can get insurance for a reasonable amount of money. And not all investment options can claim this. It's one of the things that makes real estate a hugely powerful tool. Tax favorable attributes. Now, what's the biggest reason people invest in things like 401ks and Roths? Because their money grows tax deferred. But the government puts huge restrictions on the amount of money that you can put. You can only put a little bit of money in every year. And if you're older, I can't remember, it's 50, 55, you can do catch up. And what catch up means is you can put $1,000 a year or more in. What are you catching up for at $1,000 a year? I'm not sure. But the issue is real estate grows tax deferred as much as you want, as much as you can eat, so to speak. There's no limit on how much real estate you can own other than the portfolio that you built. And it all grows tax deferred. In fact, I can sell one piece of real estate and buy another piece of real estate and still not pay tax by doing a 1031 tax deferred exchange. So the thing that we get down to is the net worth grows tax deferred over time. We can exchange those assets without having to incur income or capital gains tax. Rents can cover loans against real estate. So as your rents go up, we can then access equity out of that property. And those loans are not taxable events, but the proceeds from the rent pay for the loan, so we can harvest money out of our properties and use that money and consume it without having to incur real-time income or capital gains tax. And we can do this all legally, morally, and ethically, and we can show you how to do it as well. Tenants bring value. This is probably one of the biggest things that's misunderstood in the real estate investment world. So many people like to complain about tenants. And what I find, my family's been involved in the sales or development of real estate for 4 generations. I've seen a lot of different tenant stories. And what I find is tenant problems are usually a result of landlord inefficiency. If you don't maintain your building and it's constantly breaking down at odd hours of the day, is that really the tenant's problem? No, you're not maintaining your property most of the time. There are strategies and methods that we can point you in the right direction of, good property managers can help with, and that kind of thing, about how to manage properties without having crises with your tenants. But the thing I encourage people to look at, we've talked about leverage, the idea of a bank lending you money, other people's money, to help you with leverage and make your situation, financial situation, better. I like to encourage people to look at tenants as other people's efforts. These are people who will sign a contract with you for a year most of the time. Says, this next year, I'll go to work every day, and at the first of the month, I'm going to give you a third of my paycheck. Now, think about this. If I had 3 people all giving me a third of their paycheck, I'd have a whole paycheck without going to work. If I had 30 people giving me a third of their paycheck, if I had 100 people giving me a third of their paycheck. Very interesting how we can use the other people's money through leverage at the mortgage banking, other people's efforts through the form of tenants, and build huge portfolios we never could have if we were trying to do it on our own. We're stronger when we work together. So, another time for a poll. I'm going to give you this poll. I'm going to ask you, do you think we're nearing a real estate bubble? One of the most harmful things that I've seen for hundreds, if not thousands of people, is they're too afraid to invest. And so they come up with a story they tell themselves about why they fail to invest. I'm timing the market, waiting for the market to go down. We've done an analysis on these markets that we work in all the time. If you look at 30 years, in fact, we just did this the first of the year, we looked at 30 years of past real estate values. With the exception of the period right after the 2008 banking meltdown, every year real estate was worth more than the year before. How is timing the market going to do you any good when all you're doing is delaying to pay more for the same thing? And then many people will say, well, that dip in the market right after 2008, that would have been a great time to invest. Sure, it was. And all the people we worked with that had the ability to buy right after that time, they did. Many of our clients bought multiple properties during that dip. But you see, they buy properties every time they can. But you know what most people did? In 2007, leading into 2008, I'm not going to buy. The market's too hot. It's crazy. It's appreciating. People have lost their mind. I'm not going to pay top dollar for it. I'm not buying. I'm staying out of the market. Then when the market went down, guess what they did? Oh, I'm not buying now. The market's going down. I'm not going to buy because it's going up. I'm not going to buy because it's going down. That's a person that's making an excuse that isn't going to buy because they're fearful of a bubble. So now Lisa is kind enough to put together this awesome video, and we're going to go ahead and take a short break. And I want you guys to really pay attention to this. She put a lot of effort into it, talking about the real estate bubble reality of what's been reported in the news and the media going back 60, 70, 80 years, and let you make up your mind. So I'm going to go ahead and turn it over to Lisa here real quick, and I'll be back in just a few minutes.
For decades, the media has consistently published headlines indicating real estate is a bad investment. In the 40s, houses were deemed too expensive for the majority of people. In the 50s, the media said houses were no longer a good investment. In the 60s, the media felt a $28,000 house was way too expensive for a single-family home. In the 80s and 90s, the media told people houses were bad investments. Average house prices then ranged from $100,000 to $200,000. Today, they are selling for $550,000 to $900,000. Just a few years ago, the media was telling people to sell their homes before 2020 to prevent a loss. People who followed their advice lost out on a financial gain of 20 to 30% or more. The number of homes being bought by investors has increased to 30% on the West Coast and 40% in the Dallas area. Why? Vacancy rates are at an all-time low and new housing starts are less than the population growth, indicating a housing shortage is a strong possibility, which will drive up housing prices. Looking at appreciation by the decade, you can see that even through recessions, real estate appreciates. Look at 2000 to 2010, which covers the largest recession in our history. Prices increased on an average of 32% across the U.S. This illustrates how it's not about timing the market, it's about time in the market. Are we in a housing bubble? You decide.
Well, thanks, Lisa. I'm hoping that video about real estate bubbles make you feel safer and more confident, because what we can see is that real estate has a very high probability of being worth more in the future than it is at the present. Many times people say, well, you can't guarantee that. The thing about real estate is nothing is guaranteed. Nothing is for sure, but real estate is the safest place that we personally know of to invest. It's the same thing we do for our families, and our clients have done really well with it too, and so can you. So again, thanks, Lisa. Let's keep going. Let's talk about how can I get started as a real estate investor? I can't stress this enough. Start where you are now. If you can afford to, go out and buy an apartment building as an investment. I can't tell you how many people, look at the success stories on our website. I can't tell you how many people did not realize that they had the ability to go buy a small apartment building right now. But if you can't afford that, then maybe you buy a single family residence as a rental, or maybe in your market, it makes more sense to buy a single family residence as a rental. It just depends on where you're at and how much money you have available, or what resources you have available. If you can't afford that, then how about a condo? And if you can't afford to buy something non-owner occupied, buy a place for yourself as an owner occupant that you can later use to build equity or use as a rental. The bottom line is start where you are today. The sooner you get started, the better the result's going to be. Take advantage of our planning appointments and putting together your own personalized 5-year wealth building plan, and we'll show you how to get access to the coaching and mentorship to make your vision a reality. So let's keep going here and talk about the third pillar. The third pillar in the 6 pillars of our investment strategy is investment grade life insurance. This is a very misunderstood area of investing. There's a lot of controversy that's evolved around this, but I can tell you that the wealthiest people in the United States of America have used this for many, many generations. It's something that's more about, let's flip to the next slide. It's more about maximizing, managing wealth that you currently own as opposed to creating new wealth, but it's something that's critically important. And it's also something that's not really intuitive. You have to get started sooner, because in life insurance, the sooner you start, the cheaper it is. But those are things that we can discuss with you in more detail when we talk about your personal situation. The fourth pillar are qualified plans. Now, people often ask me, well, Paul, if I'm investing in real estate, do I still need to invest in qualified plans? The answer to that question is yes. We encourage people, if your employer has a matching plan, so in other words, many times if you put in $1, your employer will put in $1 up to 3 to 6% of your wages. So if I put in $100 a month, they'll put in $100 a month. 100% return is a good thing. Even if you don't have 100% matching, some companies have 50% matching. A 50% return is a good thing too. But what we encourage people to do is put money into there up to what your employer matches, and then let's go ahead and look at other places that are more efficient for that. The fifth pillar is stocks and bonds. Now you might say, Paul, don't we have stocks and bonds in our qualified plans? Most people do. We're talking about stocks and bonds that are not in qualified plans. We use these for longer term reserves. So the stocks and bonds give us the ability as investors to participate in the growth of the US and world economy. There's significant short-term risk to capital in stocks and bonds, and there are ways that we can go ahead and provide some more safety and security for that. But the bottom line is there is a place for this. But as I said, we're going to continue to focus on outlining the pillars and then get more focused on the real estate side. Now, the sixth pillar of wealth is our consumption strategy. Now, most people have no strategy whatsoever for efficient consumption of their assets. So if we take the traditional person who follows their traditional investment plan, the majority of their wealth is in the equity of their home, and they don't have enough money in their qualified plans to live on. And then all of a sudden they realize they run out of money in their qualified plans. Now what? Oh, I paid off my house so I'd have a place that was safe to live, but now I can't afford to live there anymore. So what happens is they didn't plan ahead for consumption. Huge amounts of money are unnecessarily lost in taxes that didn't have to be paid if you had planned ahead of time. We have to dismantle portfolios. We have to reduce our long-term returns and growth, and it's inconsistent and unreliable and unguaranteed income. The bottom line is what we want to do is we want to show you how to build a portfolio that includes how to consume what you need to live without paying unnecessary taxes, without dismantling the portfolio, without causing stress and additional costs to you and the people that you care for. Those are the 6 pillars of wealth for the Wan Group investment model. That's what we think of as true diversification. We eat our own cooking. We simply encourage people to invest the same we do so for ourselves and our family. So let's go ahead and talk about how do we build that portfolio. We're going to go ahead and we're going to use words, we're going to use numbers, we're going to use graphics. But I think what we're going to try to do here is just show you how this grows and how it grows exponentially. So we like to think of this as the ABCs of wealth creation. The A stands for accumulation. That is where we're accumulating the assets necessary to hit financial independence. B is for building equity. And C is for consumption. Now, you'll notice we're going to say this many times, but start where you are. The sooner you start, the better your impact or result can be. So how do people do this? Most people start off with their primary residence. Most people are aware that you can buy a single family home or a condo as a primary residence, but a lot of people, in fact, I'd say majority of people aren't aware that the same loan you get a house or a condo with is called conforming financing, is actually defined as 1 to 4 residential units. So you can buy a 4-unit apartment building with the same kind of loan that you can buy a house or a condo with. It's called conforming financing. So most people start off with a single family house. We've had huge successes, particularly getting young investors who are already living in apartments to buy a small apartment building as an owner occupant. And that way they can use the income from the other tenants to help build. If they could have qualified for, say, $500,000, now maybe they qualify for a purchase price of $1 million because of that income coming in from those other tenants. So just a thought. But the bottom line is people start with their primary residence and they assimilate that property and wait for the market to appreciate. So in other words, when the market's worth more, when the house, the property, whether it's a condo, single family, fourplex, what have you, when it's worth more than it was when they bought it, then they use that equity and move on to the next property. Now, there are common ways that people do this. The most common, people will sell a property and use their equity to buy a more expensive property, but it's still moving from their house to a house where they're paying for everything. We like to look at the idea of a couple of different things, but how about staying in your house, accessing some of that equity through a cash out refinance, and then buying an investment property. So you buy another property, you increase your asset base, but you've got tenants coming in and bringing in more money. So that's a way to do it. Another way to do it is to go ahead and rent out your current property, your first property, and go buy another property as an owner occupant. So in this example, we're going to go ahead and talk about replacing yourself with a tenant. So in this example, we're going to access that equity and we're going to start building tenants. And we're going to do this through refinancing and repositioning that equity into a second property. So let's go to that next slide where you see we've got a single family house. We do a cash out refi. We access some of that equity. And the first thing that we do is add to liquidity, because as we build our portfolio, we need liquid reserves. It's the first pillar for a reason. Then we use the remainder of the money that we got from that cash out refinance and use it as a down payment on a duplex. So now, instead of just having a single family home, we've got more cash and reserves, and we have 2 income producing units in the form of a duplex. So we've got a second property of 2 units, which has 2 tenants in it. So guess what? 2 properties appreciate twice as fast as 1. Let's go to that next slide, please. We encourage people to stay with conforming properties until they build what we call critical mass. Remember, we talked about accumulation, the A. Many times, the very common question, people say, well, Paul, isn't commercial real estate more efficient? Yes, it is. But it costs 2 to 3 times as much to get into as far as the wealth that's necessary, down payment requirements and cash flow requirements and that kind of thing. So building wealth is much more efficient with conforming financing, 1 to 4 residential units. And commercial real estate becomes more of an option as your portfolio grows and is more advanced. So the second thing we're looking at is when we take this property, we've got the single family home and we've got the duplex. Now it takes half the time for that market to appreciate typically. So in other words, we need that market appreciation to increase the rents in the rental property, the values in the property, and give us the ability to access equity through cash out refinance again. So now we do that cash out refinance, those rents have gone up in that duplex, right? So we can take money out of that duplex up to the amount that the rents have gone up and have no hit on our cash flow. The tenants are paying for the additional cash that's been taken out of the rental property. And we take that cash, we add it to liquidity, we start to build our investment grade life insurance pillar, and we use down payment for a couple of triplexes in this example. So now, instead of having just one home, they've got a home, they've got a duplex, and they've got 2 triplexes. So now on 4 properties, and they have 8 tenants providing them income every single month. They're utilizing leverage through mortgages and accessing equity as well as purchasing the property. They're using other people's effort in the form of tenants, those tenants that are going to work and then writing them a check every month. And they're building out the other pillars of their portfolio. So once that critical mass is achieved, then we want to let that equity grow. And we want to get that equity into a little bit larger position, provides additional security. We maintain and continue to build our reserves. As that equity builds, rent increases, we continually maintain the reserves. Now commercial real estate can become a legitimate option because our wealth situation is different. So in this example, you'll see they refinanced their 3 properties, the duplex and the 2 triplexes, and get cash out of that. And they take that, continue to build out those pillars, and now commercial real estate becomes a legitimate option. Now, we have clients do this in a number of different ways. The 2 most common or that they'll take that equity out and they'll keep the duplex, the 2 triplexes, and the commercial apartment building. Some people will liquidate the duplexes and the 2 triplexes and do a 1031 tax-deferred exchange into the new apartment building. We've had people do all of those types of things. For example, we've got a client we've worked with for about 20 years now that probably 2 or 3 years ago, they sold their smaller conforming apartments and they bought a large commercial apartment building. Then they started buying the small triplexes and fourplexes again to build the down payment to buy another commercial apartment building. But bear in mind, the whole idea of the 5-year plan is we're looking 5 years out and we're updating it every year. So we make sure we're doing what's most efficient for you. So those are the 6 pillars of wealth in the One Group investment model. This is what we believe is true diversification. This is what we do for ourselves and our family members. We've shown hundreds and hundreds of people just like you how to do this. So let's go ahead and look into a little bit more detail. And we're going to talk about market appreciation. How do we get that increase in value in real estate? One way is to wait for the market to go up in value. Another way is to go ahead and improve the property. A lot of people like to flip houses. One of my favorite things to do is flip small apartment buildings. And when I say flip, I like the idea of just improving them. I'm looking at increasing the rents. Whether you sell it or keep it is a different discussion. So let's go ahead and take a look. This is a project that I did with a few people just recently. It was just a few years ago. This property is the purchase of a 4-unit property in a really nice location. So let's take a look at these next. You can see when we bought it, it needed a little TLC. Now you got to bear in mind it was fully leased. Can we go back in the slide, please? There we go. It was fully leased, but you can see it's very dated. You can see it was built in the 80s, 90s. You look at the kitchens and the baths. You can see that the driveways are falling apart. Hasn't been painted in a long time, that type of a thing. If we go to the next slide. You can see what we did is a substantial cosmetic remodel to the entire property inside and out. There were no footprints that were changed, no roof lines that were changed, no walls that were moved. We just cleaned everything up and did a substantial cosmetic remodel. So you can take a look at what the kitchens and the bathrooms and the living areas look like. All the floor coverings, not just paint, but light fixtures and outlets and switches and doors and hardware. Every interior surface was changed. But in less than 12 months, we were able to buy that building, remodel that building, and increase the rents by 76% right at about month 9 or 10. That is one way to increase the value of an investment property. If you increase the income by 76%, you increase the value substantially. So you can see before and after of the building. It's kind of obvious. You know, on the next slide, the kitchens you can see much different, bathrooms before and after. But it doesn't matter. You don't have to do anything like that. I'm just putting it out that it's a possibility. It's something that we enjoy doing occasionally. So how do you finance these strategies? So this is a big thing. So when you go out to get a loan to buy a house, you don't have a home. It's easiest time is your first time. It does tend to be seem like a big deal because people have never done it before. But that's really the easiest place to get a loan. It's basically mortgage financing is a commodity. The lenders all get their money from the same place. We need somebody who has the ability to put some place together with the right loan and that kind of a thing. But when you're building portfolios, it's a completely different sport. The majority of loan officers don't do apartment building financing. The majority of loan officers don't build portfolios where we have 3, 4, 6, 8, 10, 12, 15 mortgages. And so at the One Group, we go to some efforts to develop relationships with lenders who have the ability to help manage that portfolio of mortgages, because that becomes just as much of a part of your investment portfolio as anything else. So there's a difference between good debt and bad debt. We've talked about that. We've talked about refinancing and harvesting equity and balancing assets. Good debt, very simply put, is money we borrow for creating more wealth. It's simply that. We encourage people to use debt to manage their tax liability and build their net worth. Bad debt is money that's borrowed for the purpose of consumption. For example, going on vacations you can't afford to pay on a credit card, and then you have that payment. Yeah, there's a saying that if you can't keep up, you can't catch up. So if you can't afford to do something, you borrow money to do it anyway, you better have a plan to pay it off. Otherwise, you're just going to have an insurmounting level of debt. That limits your ability to borrow, limits your ability to invest. So whenever we're talking about acquiring new debt, we're talking about good debt, which is going to increase your safety, liquidity, and choice and control. The reality for many Americans is that home equity is their largest asset. We've talked about this a little bit already. But bear in mind that money is not working for them. This really surprises a lot of people. Owning their home free and clear is their primary goal. Qualified plans are their only retirement savings, and they find comfort in doing what everyone else is doing, even though 2 out of 3 people in this country are going broke during retirement. But everybody else is doing it, right? Not such a great idea. So the $1 million question, as they say, what if you learned that a large majority of your wealth was earning a guaranteed 0% rate of return before inflation? Let's think about this. If you have net worth growth with 100% financing versus owning a home free and clear, we talked about that already. That money that's trapped in your home is lazy, idle dollars. It does nothing to enhance the net worth. Remember, we talked about leverage. When the market value of real estate goes up and down, it goes up and down for every piece of real estate, regardless of whether it's leveraged or not. We're going to encourage you to give your equity new life and allow it to grow and compound. And the value of the asset is much more important than the individual loan balance. So your equity should be put to work. If you have employees at a business and they don't go to work and they draw a paycheck, you're going to have a problem. If you have assets that don't make a return, you're going to have a problem. And we're going to show you how to increase that liquidity and use that underutilized asset. So let's talk about basic mortgage qualification. The primary variables in any mortgage, now this gets more complicated as we get multiple loans and multiple properties, but it's important to understand the basics because it all typically comes down to the basics in the end, but just in a larger scale. So we'll use an example of a qualifying income of $120,000 a year, $10,000 a month. It makes it easy for an example. We'll assume a debt to income ratio of 45%. This is what the lender will allow the debt ratio to go to. And your debt ratio has to do with your house payment, principal, interest, taxes, and insurance, PITI, plus anything like consumer debt, like a car payment, student loan payment, minimum payment on a credit card that you might carry a balance on, that type of a thing. I've seen very high debt ratios approved, particularly with some government programs. And I've seen some more conservative lenders be a little bit lower, but 45% is the most common. So all your consumer debt, whether it's your house or car payment, gets built into there. Your taxes and your insurance for your real estate, your homeowner's insurance, tells us that if we take 45% of our gross monthly income and we subtract our consumer debt, that tells us how much we'll have left over for a house payment. Go to the next slide, please. So in this example, 45% of $10,000 is $4,500 a month. Let's say they have consumer debt of $500 a month and a car payment. We're going to assume that the real estate taxes will be $746 a month for this property. The insurance at $84 a month. And if we run those numbers, we subtract from 45 that 500. That gets us down to 4,000. We subtract the 746 and the 84. That leaves us at 3,170. Now, interest rates move every day, but let's say we have an interest rate of 5.5%. That would give us a loan amount of $558,306. What kind of income qualifies? Virtually any type of income. The issue is how long does it have to be seasoned? So contractual income, like a salary, is much easier to do because you have a contract with your boss and company, what have you, and they're paying you exactly what they say they're going to pay you. But we can use hourly, we can use commissions, we can use business profits, we can use seasonal employment, all that kind of thing. But if it's not contractual, then it typically has to be seasoned over 2 years. Okay, go to the next slide. So let's talk about that ratio. We said about 45% is the most common. We can go a little higher, a little lower, but that's a really good example. So just bear in mind at $120,000 a year, that's $10,000 a month, that's $4,500 a month for debt service for all of your consumer debt. There's not a lot of flexibility in this, simply because lenders realize that if your debt structure gets too high, it's very hard to stay afloat financially. The only exception to that is as incomes get very, very high, we can get that ratio higher simply because basic cost of living, a Chevy pickup doesn't cost more for a millionaire than it does for somebody who makes less money, right? A hamburger doesn't cost more for a wealthy person than somebody who's not wealthy. But 45% is a good number to use. And what gets qualified into that, again, we mentioned it really quickly, but you have to be careful because what we really encourage, the most powerful thing investors can do is not get a lot of consumer debt. We want to use your debt to income ratio for qualifying for income producing real estate. But here's where we see people get into situations that limit their abilities. They get higher auto loans, credit cards that they carry balances on and don't pay off, student loans, any kind of contractual debt. The issue is can you not pay it? Then it doesn't count typically. That's a good rule of thumb. If you have to pay it, then it typically counts as consumer debt. So the house payment itself, you've got your 45% of your income, your debt to income ratio, you subtract your consumer debt, the rest can be used for a house payment. House payment is broken down into PITI, principal, interest, taxes, and insurance. Principal is the amount, paying back the amount of money you owed. Interest is paying interest on the amount of money you owed or you borrowed. The taxes are your real estate taxes, and your insurance is your property hazard insurance. Now, in this same example, same income, we're going to go ahead and our takeaway is considering reducing or eliminating consumer debt to make more borrowing power available for real estate and mortgages. Example, at a 5.5% interest rate, $1,000 a month in consumer debt reduces your borrowing power in the terms of getting a mortgage by over $176,000. So let's take a owner-occupied typical mortgage. This person just going out and buying a house. They make $4,500 a month. They've paid off their debts. They don't have any car payments, that type of a thing. We'll assume that their taxes and insurance are $826 a month. So we subtract $826 from the $4,500, which means they can spend $3,674 a month for principal and interest at 5.5%. That is $647,071. You add your down payment to that, and that's what your purchase price would be. Pretty straightforward. So how do we increase your borrowing power? Tenants help us increase our borrowing power dramatically. They can increase our income. We can add partners and that type of thing. Increasing your income is kind of hard to do. Most people, if you could increase your income, you would have. Developing partners has its own set of challenges that come with that. The best option that we've found is adding tenants to the mix. So additional properties bring more expenses, but they bring increased income through rents. The rental income can be a direct offset to your mortgage expense. Why is this important? Rental income is almost twice as powerful as earned income in your ability to borrow in many instances, because the income on a property is used as a direct offset for that property. Where, remember the debt to income ratio, if I earn $1, I can spend 45 cents. Well, the income that comes into your property can be a direct offset to that, so it can be approximately twice as powerful as additional earned income. So let's use an example. Take a look at this little fourplex. There's 4 side-by-side townhomes with garages in this graphic, right? We look at the renting for $2,000 a month per unit. That's $8,000. If I added $8,000 a month to my income and used it in traditional underwriting standards, it would increase my purchasing power by $634,000. When I use it as a direct offset, it increases my purchasing power by over $1 million. That's the power of tenants. And there's really no other way that we know of to get to that. But when we include other people's money in the form of mortgages, other people's efforts in the form of tenants, and redistribution of underutilized resources in the form of refinancing, we start to get to the point where we have an actual viable solution to being financially independent in your lifetime. So let's do a quick example of using home equity to buy rental property. In this example, these people have a home that's worth $1,150,000. This is a real world example from somebody that actually came to this presentation, by the way. They owed $529,000 on a 15-year loan. They were trying to pay it off quickly, like most everybody else. Their current payment for principal and interest was $4,322. The new financing plan that we did was 6% interest only at $920. The new payment was $46,000, but that got them $391,000 available in free cash and a cash out refinance. The additional monthly cost was $278 a month. Their house payment went from $4,322 to $4,600. Easy for me to say, right? The additional cost was $278 a month, but that gave them access to $391,000. That was currently idle and making no money. With that $391,000, they used $375,000 of that as a down payment on a non-owner occupied 4-unit apartment building at $1.5 million. The principal and interest payment was $6,388. Taxes and insurance, $889. The new monthly payment on the fourplex was $72.77, and the current rents were $8,000 a month. Their projected initial cash flow is positive at $723 a month. Now let's take a look 5 years down the road. That $375,000 cash was used for the down payment on a $1.5 million 4-unit property. The reason we did it that way, it takes about 25 to 30% down to get to cash flow neutral or positive and cover those expenses. But they added $1.5 million in appreciating assets to their portfolio, plus 4 tenants, and $8,000 a month in rental income, and the opportunity cost was $278 a month. Now, if we looked at 5 years down the road, the primary residence value at a 9% appreciation level, which is about average in all of the major metropolitan areas that we work year in and year out for decades, by the way. The primary would be worth about 1.7. The 4-unit now worth about 2.3 for a total value of just over $4 million in appreciating assets. That's an average annual appreciation of $366,000 a year. What's the probability that you're going to save $366,000 a year? This is why people that invest in real estate typically get rich. Because if you can do that once, you can do that twice. Remember, we told you a client started with us right after college graduation, no special job, no special resources. Recently, their portfolio went up in value by $3 million in just 1 year. Started off with nothing. So, we've talked about using other people's money. We've talked about using other people's efforts through tenants. We've talked about repositioning underutilized resources like home equity or trapped equity in other properties. How most millionaires make their money is through investing in real estate. And these issues that we've been talking about are the ones that make it happen. Those are the functions that most people don't take advantage of. Not all people in real estate or lending know how to do this. We have done this for thousands of transactions. We can show you how to do it. We can coach you every step of the way. And we can help you build your dream real estate portfolio, not only for yourself, but for generations to come if you structure it correctly. We've spent decades in teaching people how to do this, teaching our staff how to go through this process and help other people do it. And we're very, very excited about helping other people achieve true financial independence and freedom. So why do our strategies work? We like to think about it as the 6 monetary efficiencies. We've talked about the investor mentality. We've talked about utilizing all your assets. We've talked about how compounding, getting that interest return, compound interest or that rate of return up is important. We've talked about leverage or other people's money. We've talked about tenants or other people's efforts. And we've talked about tax strategies. But only when we put them all together in a cumulative resource can we find something that's actually going to solve your issue of being financially independent while you're still young enough to appreciate it and use it. So, is there something holding you back? After thousands of client consultations, I found that sometimes people feel like they lack knowledge or resources or time or vision. We can give you access to the knowledge. We can show you where to find the resources. You have just as much time as anybody else in the world, ourselves included. And we can help you clarify that crystal clear vision because that is so crucial to being successful. We also find that some people fear something. One of the most common is the unknown. I haven't done it before. A lot of people fear leasing. Some people feel fear of maintenance or tenants. It took me years to learn this, but many people fear success. I would see people start to become wealthy and then sabotage themselves because they didn't see themselves as wealthy. But if there's something holding you back or something you fear, we can show you how to work through that and get access to the resources you need to make positive progress and move in a direction that's good for you and the people you love and care for. So, if you haven't done so already, schedule a planning appointment today. Here's what you can expect. Our team will gather your personal information and discuss your financial goals. What are you really looking at doing? We can help you start to understand what does success really look like for you. Some of you will find, if I had $4 million to invest, I would be completely comfortable. Some people would be 10 million. Some people it's 2 million. Some people it's 20 million. The bottom line is, what does success look like for you? And then we can show you strategies that you can use to build wealth from where you're at today and what's in your best interest. So take advantage of that 5-year wealth building plan, and we'll show you how to do that and continue to do that throughout your life. This is one of my favorite things. I think about this a lot, but vision without action is merely a dream. Action without vision just passes the time. Vision with action can change the world. I see so many people so busy accomplishing nothing. And I see so many people with these big dreams that do nothing. People die every day with unrealized potential. It's what you do that makes the difference. So the question is not whether the formula for success will work, my friend. The question is, will you work the formula? We can show you how to do it, but we can't do it for you. Take advantage of that. We're here to help, and we love the idea of being able to help more people. So where do you go from here? You have to make a choice. Stay on your current path. If you are completely dialed in for your highest net present value of net worth for your entire life, taking into advantage absolutely best asset orientation and allocation, best tax and liability mitigation, estate planning, and you have got it dialed in to the penny that you have maximized everything, then stay on that path. If you don't have all those things, then set up your plan. And your planning appointment will show you how to get there. We can provide you with the resources and access to us and other professionals you need to achieve real phenomenal success. So we've showed you that you can create your 5-year wealth building plan. We've showed you can access coaching and mentorship. We can show you how to make your vision a reality. So this is where we started off. Where do we go next? Start where you are today. As I said, you'd be shocked. There are many of you sitting out there right now that can buy an apartment building, just don't know how to go about doing it. Many of you who could find maybe a single family or a condo as a rental would be better for you. Maybe you just need to go buy a first or a new owner-occupied property. Maybe you need to buy your first property, or maybe you need to rent out the one you're currently in and buy another. The bottom line is we'll help you create that 5-year plan and give you access to the knowledge and the experience to determine what is in your best interest from where you're at today. So, congratulations on attending our Wealth Creation Strategies webinar. That's your step one. Your next step would be going ahead and registering for your planning appointment, which there will be an information gathering session where they'll get your financial questionnaire and talk about what your goals are. Then we go through an initial planning appointment. And that's where we get into the idea of how do we figure out what your best case scenario is. We'll model what you're currently doing and model what the next steps would be like, and then discuss what you could accomplish if you did everything you could in the next 5 years. Many people require a second planning appointment. It depends on how complicated your situation is. And then we simply initiate the one group investor model. And then we get into portfolio reviews. Once you've done that first step, we review your portfolio every 6 to 12 months and ensure that you stay on track to realize your best case scenario. So if you haven't done so already, schedule your consultation or go ahead and click on the link there. And if we can head to that next slide, we're going to have a question and answer session. Lisa and I like to try to do this together. We're in different offices, but hers is just upstairs from mine. So I'm just going to go ahead and put us on a short break, and I'm going to run up and touch base with Lisa. Now, a number of you have put questions in the chat, the moderators have been putting those questions together. If you have questions and haven't put them in the chat yet, go ahead and get them in there while I'm moving to the other office to join Lisa. And then Lisa and I'll go ahead and answer your questions in a live chat session. So we appreciate everybody attending today. It's been wonderful seeing you all. And we look forward to talking with you again here soon. Till next time.
And Paul was running upstairs to try and...
It's okay, I made it. I can still read.
Yes. So in case I'm not sure exactly what all those tech problems were, but in case you missed it, Paul was coming up here to join me for the Q&A, and we are now going to answer some questions.
Great.
So please, if you have anything else, go ahead and put them in the chat real quick, and we will get started. So our first question is one that we get a lot of.
Okay.
So a lot of people want to know, how much does this cost?
How much does this cost? Well, apartment buildings usually $1 to $2 million. But how much it costs for our services? We focus on the idea of working with people for years at a time. Many of our clients we've worked with for 20 years or more. We basically develop a relationship with our clients, enter into an agreement with them to help them build their portfolio. We get paid the selling office commission or listing commission when they buy or sell real estate, just like anybody a real estate agent does. We don't charge any additional fees for our services, but we bring a tremendous amount of value. What we find is that when we do our best job to help our clients make money, they will go out and tell their friends and neighbors and people that they know about what we do and refer us to those other people. In fact, the last time I looked at that, 87% of our business was repeat or past or referral clients. So that's the way it works. Because it costs you anything extra, but there's a huge amount of value. That answer the question?
I believe it did.
Okay.
So the other one here is another one. We get this one from California. Mm-hmm. Somebody asked us, my retirement funds have been shrinking, and I'm thinking of moving that into real estate. How would you recommend doing that? And can I buy a house or property within my IRA?
Sure. Good question. We get a lot of those. A lot of people see their IRA shrinking, and as you get closer to retirement, it gets more strenuous and stressful. The reality of the situation is we can show you how to purchase inside an IRA, purchase a piece of real estate inside an IRA. Lisa and I have done the same thing. We've helped other clients do it, that type of scenario. It is significantly more complicated, but we can walk you through these steps of how to do it. And I think it could be a great way to go for a lot of people.
Okay. No, I agree. I absolutely agree. It amazes me that how much more money you can make in real estate than you can in your traditional 401ks and stocks and so on.
The nice thing about an IRA is that it gives you one of the few abilities to use leverage and tenants. And that's something that you don't find in most assets within retirement plans.
All right. This next one, hear a lot in the market.
Making me nervous.
No, but it's about high interest rates. You know, a lot of people, there's been a lot of fear.
Has anybody seen any high interest rates lately? I haven't seen them since the 80s.
Well, okay, all right. But the question, the point is that they're higher than they were last year. And the real estate was just booming last year. So there's a lot of fear right now that buying real estate right now with higher interest rates isn't the best thing to do. So the question was, wouldn't we make more money if we waited until the interest rates are lower?
Well, I'll give you two answers to that question. The simple one is no, heck no. And the second one is, let's go ahead and talk about interest rates a little bit. Interest rates are somebody lending money for the purpose of making a profit. In order to do that, they have to have a company, they have to have staff, they have to have accounting, they have to have licensing, they have to have compliance and all this kind of thing. So what you'll find is that when COVID hit, the US economy, Federal Reserve in particular, artificially lowered interest rates by subsidizing it by billions and billions of dollars. That was not real. That was false interest rates. Cannot be maintained. Historically, we see 6 to 8% about average. And when I was kidding around about high interest rates, my family's been in this business for 4 generations. Remember my dad working through the late 70s, early 80s with interest rates at 21%. So when people start to get all twitchy when it gets close to 7, I'm sorry, it just kind of makes me crack up. So let me make this as simple as possible. When COVID hit, the federal government was worried that the entire US economy would collapse. If the value of real estate collapses, our whole economy will go down. It's a mathematical certainty in our opinion. Therefore, they lowered interest rates, basically made money free. They were lending money at less than the rate of inflation. In fact, less than CPI. So when Lisa and I got our last mortgage, 2.875% about a year and a half ago. Okay, not our last mortgage. We got another mortgage just a few months ago for an investment property at 6%. And we were thinking that was kind of high, but now it's like 6.5, that kind of a situation. So these things change. But the reality of the scenario is if you're waiting for rates to go down below where they're at now, you'll be waiting to another lifetime, in my humble opinion.
Well, then you miss out on some deals right now. I mean, not deals, but you miss out on people that are looking to move properties, but a little bit slower. So it's a good time to buy. And also, if you wait too long,
it's
you're
not
gonna
that much slower. For the record,
that's true.
New investor buyer just met with yesterday. They identified 10 properties less than 2 weeks ago they were interested in. Yesterday, 5 of them had sold. Not really a slow market. But I do want to point out one thing one of our lenders mentioned, which I think is a great idea, which is marry the property and date the rate. So when you get down to the situation, what you'll find as investors, every time you can afford to buy a property and have reasonable cash flow coverage, do it. Then if the rate drops, then you can refinance it and reduce that interest rate. Now think about the other side of that, the flip side. If you don't buy because you think for some reason that rates are too high, and you get into a situation where rates drop, but now the property is 100, 200,000, 300,000 more than what it was before, you can't fix that. That's unfixable. It's called poor. Okay? Just bummer. So the bottom line is every time you can afford to buy a high quality investment property and cover your cash flow, do it. If rates get better and improve, refinance. One thing as an investor, you're constantly going to be refinancing your mortgages.
Well, and the other thing on that too is, that same mortgage broker pointed out, is that as an investor, does it really matter what the rate is as long as you can get your tenant to cover your mortgage payment?
If I get to buy an appreciating asset, I put down my down payment and my closing costs, and it doesn't cost me anything afterwards, I consider that a win.
Mm-hmm. Yep. All right, we have time for one more question.
All right.
We have a vet in the audience today, so thank you very much for your service. And what that vet had asked is, can he or she use VA benefits to buy a investment property?
Absolutely. Now, we've got a number of veterans. I'm a veteran myself. The bottom line is with VA, the only issue is it has to be owner occupied. So a lot of our veterans will do a really cool trick, especially if they're at a time in their life when they can do this from a familial standpoint.
Mm-hmm. Mm-hmm.
They'll buy a fourplex, 4-unit apartment building as an owner occupant,
Mm-hmm.
zero down.
Mm-hmm.
Wait for the market to appreciate so that the rents cover the entire expense. Refinance that into a conventional mortgage, and then go buy another fourplex, zero down. That's probably the most radically efficient thing that I've ever seen. In some markets, I mean, that works great on the West Coast.
Mm-hmm.
As you know, we work in Seattle and LA.
Mm-hmm.
In Dallas, might take a little bit different approach because in Dallas, at the moment, single family rentals are a little bit more profitable than the fourplexes.
Mm-hmm.
It's the only market we've identified that works like that. So don't take that, traveling, but that's something that we've seen. So the bottom line is, yes, the difference is with VA, you have to buy as an owner occupant. So what investors do with VA, they buy as an owner occupant, wait for the market to appreciate, refinance into a conventional mortgage, and then go buy the VA again.
Well, thank you. And we're out of time, but I did want to thank everybody for joining us. And also, if we weren't able to get to your question, schedule your planning appointment. And we have some great people. We have a great team, both in Washington, California, and here in Texas. And they can answer any questions that we weren't able to get to. So look forward to meeting you in person or via Zoom and your planning appointment soon. And have a great day.
Thanks.
Thanks. Bye-bye.
See you next time. Bye-bye.